With the cash rate at a record low and interest rates paralleled, the question is, now a good time to fix my mortgage has never been more prevalent. More and more I'm being asked, but what factors should you consider? And how do you know now is the right time to fix in your mortgage? Well, firstly, let's see the difference between your two options, both fixed and variable. From there, we'll delve into the mechanics that'll drive your decision making. A variable rate is an interest rate that increases and decreases with the market, and over time generally allies itself with the cash rate. Your repayments too will sway with this movement. Essentially, the higher your rate, the higher your repayment, with the converse also being true. With a fixed rate, you typically choose from 1 to 5 years. It's in this period your interest rate doesn't change. As the name implies, it's fixed. Ordinarily, a standard home loan term is 30 years. So, if you choose a 5-year fixed rate, once it ends, you'd revert to a variable home loan with still 25 years remaining. It's at this time you can elect to go for another fixed rate or elect to stay on the variable. Too many jump into a fixed rate when the banks are offering an enticingly low rate, but don't fix in based on this. When you're at a casino, the odds are stacked against you, and like a casino, the goal for the bank is to make money. With fixed rates, their goal is that the fixed rate will be higher than the variable rates in the same period. If successful, they reap the reward. By understanding this, we can make a better subsequent decision, and rather than getting caught in their trap, avoid it completely. So why should you fix? Flipping this based on rates, you'll always be frustrated, as if rates were to decrease, your inclination would be to break and chase the lower rate on offer, which only leads to fees and charges, including what's known as a break fee. Whilst a fixed rate has a number of fantastic perks, one of the detriments is a break fee, essentially a fee based on how much the banks lose by releasing you early. How it's calculated is the difference between the bank's cost of funding at the time you fixed and at the time you break it. So, let's say you elected for a 2-year fixed on your $500,000 mortgage. At the time, the bank's cost of funding was 3.55%. This isn't the rate you're offered, it's simply the costs of the banks to secure these funds, also known as a wholesale rate. 18 months later, you break this. Now, the cost of funding is 2.65%. This means the break fee for leaving 6 months early would be roughly $2,250, or 0.9% multiplied by 500,000, which is the annual break fee, divided by 2, as only 6 months remaining. For many, choosing a portion fixed and variable offers the best of both worlds, but the problem for many is how to determine the correct split. Many in the industry say to simply split the fixed and variable portion 50-50, essentially allowing you to hedge your bets. But if you've chosen the fixed rate for the right reasons, this isn't necessarily the correct split. Most lenders allow you to have the portion fixed and variable, but do limit it on product criteria, meaning that a lot won't allow you to split on their flagship, no fee and low rate products. But details aside, to determine the right balance, you first need to understand what your budget affordability is. In this case, we meet Mr. and Mrs. Smith, who can afford $3,500 per month comfortably. They've mortgaged $500,000 and elected a 3-year fixed rate at 5% over a 30-year term. So, firstly, we'll understand what their minimum principal and interest repayments come to. In this case, roughly $2,684 per month. From there, we simply minus what they can afford, $3,500 per month, which leaves us approximately $815 per month, or close to $30,000 per annum. So, in this case, the correct split would be $470,000 fixed and the remaining $30,000 variable. The biggest issue with fixed rates is ordinarily you don't have access to a redraw, offset, and are limited to how much more you can pay on top of the minimum repayments. But the same, a variable rate has its drawbacks too, as rate fluctuates over time, offering no certainty. Knowing your reasonings before you fix in will enable you to make the right decision for both now and in the future. With mortgages, there's so much more than just the interest rate. And by understanding this, will allow you not to be played by the dealer and ultimately Take control over your financials, tailoring it to suit your needs. Thanks for watching, and please remember to like and subscribe, and we'll see you next time.